Hi, I'm Seth Freudberg. I'm the Director of Options Trading here at SMB in Manhattan. And today we're going to go over the weekly broken wing butterfly, which is a great trade. It is a trade that is a favorite of options professionals, of market makers in general. And I think you're going to learn a lot from today's presentation and hopefully take something valuable away from it. I'd first like to start by mentioning that SMB Training is not a broker-dealer. This presentation is being given for educational purposes only, and today's presentation contains no relevant positions, and hypothetical trades, as you're about to see, are just estimates of market prices. Those estimates are possibly not attainable in the marketplace because of liquidity, slippage, and commissions. Please trade options carefully, as there is great risk in options trading. So with that, I'd like to talk about the broken wing butterfly. Now, you may be saying, the broken wing what? And I have to admit that we have very oddball nicknames in the options world. I don't know how that got started, but we give everything a nickname. If it's a trade, it's got a nickname. And we've got something called a butterfly. We've got something called a condor. There's even something known as a strangle, and you can see Homer Simpson there strangling someone. They're just weird nicknames. I can't explain it. Yes, I know it's weird. So let me tell you a little bit about a butterfly. A butterfly is a trade where you sell two options, oftentimes at or near the money, and you buy options on either side of it that are called wings. And as you can see from this example, we have a butterfly at the in the Russell 2000 index, and you can see that there are 20 sold in the middle of the index, and there are two equidistant puts purchased on either side of the butterfly. And so this is an example of a butterfly in a what's called an analyzed graph, and essentially this shows you the range of prices in the Russell 2000 index over which you would make a profit if you held this butterfly until expiration day. And as you can see, with a conventional normal butterfly, the range of profit is such that on either side, the risk of a complete loss is exactly the same on expiration day. So that is a normal, conventional put side butterfly. The broken wing butterfly, on the other hand, is distinguished from the normal butterfly in that the wings are not equidistant from the central short position of the butterfly. So in the example that you're seeing right now, you'll see that the long puts above the shorts are at the 1090 strike. The shorts are at the 1070 strike, and then the long wings on the below the shorts are actually at 1020. So 50 points away versus 20 points away. And that's what this looks like in terms of a risk graph. As you can see, with this structure, if the market rallies, sells off just a little bit, or stays exactly where it is, you will make a small amount of money because you've received a credit for this broken wing butterfly. But if the market sells off, there's two scenarios. One is, if it sells off too hard, too fast, you'll have to close the trade at an exit at a loss. The second scenario is where you would make a great deal of return compared to the risk that you have in the trade. And that is because the later that the market sells off into the tent portion, we call that, of the butterfly, the later that happens in the trade, the more you can make some excellent money, excellent return. So the broken wing butterfly is sort of thought of, in this case, a credit broken wing butterfly is thought of as a credit spread with a lottery ticket. In other words, you're going to make money on the thing. You're going to make a minimal amount of money as long as the market doesn't sell off too quickly. If the market does sell off slowly and gradually through into expiration and actually sells off the most into expiration, as long as it doesn't go past the butterfly, the potential for returns is excellent. So it's a very interesting trade in that Just about every scenario gives the potential for a profit, but there are scenarios, of course, where you will take a loss, as with any form of trading. So what I'd like to do now is go over some general guidelines for broken wing butterflies. For a put side broken wing butterfly, one thing that people like to do is to trade the indexes because you don't have to worry about earnings. Gigantic, massive gaps first thing in the morning typically do not happen to indexes like they may for a stock. So some people like to put on in the weekly options chains for indexes a broken wing butterfly every week. So this could be a potential strategy that someone could possibly get involved in. And so you'd want to put this on at a credit, and you have to structure it so that it's a credit. And then you want to be out maybe, I don't know, 10 to 14 days, something along those lines. I like to wait for a day where there's a sell-off in the market, because you usually can get a better credit, and also you can get farther out strikes from the money, which makes it a safer trade. And volatility is up, generally speaking, on down days, generally speaking, especially hard down days. So those are very good days on which to place a put side index-oriented broken wing butterfly on the weeklies. If the market then stays the same, rallies, or sells off very slightly, you can close the trade for the credit you received. If the market sells off gradually down into the middle of the tent towards the expiration day, then you can really make some good money, provided the move down is not so hard that it actually blasts through the bottom of the tent of the butterfly, in which case you're going to have to take the trade off for a loss most likely. So on the upside, it's kind of easy. You pocket your credit. On the downside, you have to trade with some skill, and that's the art of trading broken wing butterflies. So let's take a look at a few examples.
Okay, so let's take our first example now. We'll go back to December 10th, 2013, and you'll see that the market at around 12:30 on that day is selling off, so that's a good thing. It's better to do these on sell-off days, although certainly you can make money if it's not a sell-off day, just probably heightening your probabilities a little bit. Let's take a look at the price chart. The market was rallying. This is the S&P 500 index, so these would be the SPX index futures. And you can see that the market's been generally hanging out above its 20-day moving average. Some people think that's bullish. I'm not saying it is or it's not, but I'm saying that you could use that as an indicator to decide whether you basically believe we're in generally bullish conditions. In that case, then, we'd go ahead and we'd put on our broken wing butterfly at 16 delta, and you can see the wing above the shorts is a bit closer than the ones below the shorts. And so our profit graph looks something like this. And as you can see, if the market continues to rally or goes backwards a little bit or stays exactly where it is, we're going to make $470 on the trade. If the market sells off, we have a chance to lose, or we have a chance to make a lot more money. If it happens later in the trade, we'll make a lot more money. If it happens too early and too sharply, we probably will have to exit at a profit. So let's go through the end of each day and see where this takes us. So first off, we'll go to the end of the day. We put the trade on. Market sold off a little bit more, and that's going to make us some money, generally speaking, because it didn't move much after we put it on, and we have positive theta. In other words, we have time decay working in our favor on all of the income options types of trades that we teach here at SMB. Now, the next day was a big down move, and so that's usually not advantageous for these trades. If you get an early an early sell-off, and that's exactly what happened here. So it's no surprise that we're down $610. But that's not that big of a deal for a trade like this. We're in the very early days, and we're not going to get too worried about that. Now, the market the next day sold off a little bit more. Now we're down $1,200. Now things are getting a little bit more serious. What's happened is we've entered the body of the butterfly, but we entered it too early in the trade, so that the short options have really blown up in value and that's really what's causing the issue, even though the long options have also blown up in value. We've got 20 of them down here, and we're almost at those short options. So we're 8 days out from expiration, and now we're down to $1,260, but we're not in any kind of a condition we would consider, a must exit. And then finally, we go into the next week, and the market, does nothing. I'm sorry, the next day the market does nothing, and we're going to go in over the weekend, and that's a good thing because we're in the last 7 days of the trade, and now we're going to start seeing some movement of our time decay because the market is, running out of time for all of the options, and as a result, by the end of this next day, we've gotten back, almost all of our profit. And so you can see here that the trade is now, pretty close to break even, and we've moved out of the butterfly and into, I guess you'd consider a safer zone, but a lower reward zone. And then we'll move to December 17th, and as you can see on December 17th, the market sold off again, and so we're on the edge of the butterfly. But now, if we move into the butterfly towards the end of the trade, it could be very, very interesting. And so now we're going to move to the middle of the next day, and as you can see here, even though the market sold off, now we are inside the butterfly. But now it's getting interesting because if we kind of hang out in here for a while, we could be up big money, or even if we come out of it, we could be up big money. And so let's take a look at what happens after this. Now we'll go a couple hours later, and you'll see that the market has sold off into the center of the butterfly, and all of a sudden a rally occurs. And that was, there was a Fed announcement that day, I believe, and the market started to rally. And so what happened was we suddenly jumped out of the butterfly into this zone where we're closer than we were when we got into the trade relative to the short strikes, but we are now above the market. And so suddenly we can make much more than we could have having stayed till this trade till expiration, because the most we can make on expiration is this $470. But because of the interactions of all of these options, suddenly these that we sold for $5.55 are worth $1.81. That's the major reason that we're suddenly profitable. And so this might be a good time to just go ahead and take the trade off and consider this a victory. So that was a trade that you would have done and hung in there according to guidelines that we can teach you if you're interested. And but that was one example of where a weekly, we started 10 days out, and 8 days into it, we were able to take it off for really a very strong profit, more than 10% of the capital that was in the trade. So that would be that trade. Now here's one, and I want to just mention everybody, you're going to lose on these trades sometimes. I'm happening to show you some some examples of winning trades, but you're going to lose as well. As you can see on that trade, if the market had kept going and selling off further below the body of the butterfly, especially early in the trade, you'd have to take it off because it would get too dangerous. But there are many, many opportunities. And what I love about the broken wing butterfly is that there's most of the scenarios are profit scenarios. If the market rallies, you're going to make a profit. Now here's another one on September 18th. Here we're selling it for 100, and we're going to get a credit here if we hold this to expiration of $157. That's the credit we received originally. We'll be able to pocket that credit if the market rallies, if the market stays the same. If the market goes down no lower than 1,700, then we would also make that 157 if we hold the butterfly till expiration day. However, if the market sells into this area at the right time, then we have the potential to make much more. Now, this is a fun example. This does not going to happen very often, but it just gives you a sense of the realism of these trades and what are the, I should say, the possibilities of these trades. So let's take a look at this now. We've got a initial sell-off, but again, with these trades, as long as you get sort of mild movement, you get a chance to earn a little bit more profit than you would on the credit that you sold. Again, market sold off further, but it's somewhat of a gradual sell-off, and so we are not going to be in any kind of a desperate situation. Now, the market sold off gradually and further, and now we're actually getting close to that 1701, and you can almost also see that the price is the profit level on this trade is now 1727. So we'll go through to the next day. And what's interesting about the next day is the market on that day sells off a little bit further, and what's happening is almost a perfect scenario for a broken wing butterfly. The market is slowly gravitating into the body of the butterfly. So even though we do have a locked-in profit above the, above the level where the market was originally, in scenarios where we sell off, as long as it happens gradually, we can actually get up some really big money. So let's go to the end of each of these days and take a look at what happens with this broken wing butterfly. And here, market sold off further, and now we're at $930, a full, what, 5, 6 times, more than 6 times the credit we received. We're now up profitability-wise. And the market, again, this is one of these rare grinding down situations, and you can't expect this to happen too often because the market usually will sell off a little harder, than this when it's going to sell off. And then we had a rally on Thursday, September 26th, which is 2 days before these expire. And as you can see, now we're up really quite a bit. And that's because now we're up, 10, 15 times. Looks like close to 15 times or more. Yes, more than 15 times our original credit. And that's what can happen with these broken wing butterflies. They can really blow up in value if you kind of hang out near the body of the butterfly towards the end of the expiration cycle. Now, what I'm going to show you next is something that you cannot expect to happen maybe ever for you. And it's just sort of one of these fluky things. We had a sell-off the next day. The market ends up almost, exactly at the short strike, and now we're up almost $8,000 on a trade that our worst case scenario was $9,800 of capital that could have been lost if you didn't prudently trade. So here we're up, $8,000 by the end of the day. And that is, it's not going to happen much that you're going to end up right at your short strike, but on a butterfly, if the market expires at your short strike, you're going to make the maximum that you can make on that butterfly. So as you can see, what was a pretty sure bet of $157 now becomes, a gigantic return relative to the amount of capital, and you get that return in 1 week. So, but the truth of the matter is, no trader I know is going to sit around and allow themselves actually to get up this much money, because the issue is that on expiration day you have so much gamma, what's called gamma, which could be explained, but essentially if the market moves a little bit, it can cost you a lot of profit because of a factor called gamma. And so therefore, most people would have gotten out, earlier in the day, up a lot of money, but maybe less than $8,000. So I want you to realize you are going to lose on these trades sometime. If you get down here, you're going to have to be out of the trade. But there are so many scenarios where you make money that it's a really interesting trade. It's one of our favorite trades here at SMB. So with that, I was hoping you could get something out of these examples and get a feel for the potential and the dynamics of a broken wing butterfly.
Thanks very much for attending this session on broken wing butterflies. I hope that you learned something from it. Maybe you have something you can take away and experiment with in the marketplace. If you do, really use very low capital because you have to get used to these kinds of trades and how they work. And just like anything else in life, start out small and then you can build up over time. If you have any questions about the broken wing butterfly or our options training program where we teach strategies just like this, you can contact me at sfreudberg@smbcap.com. Thanks very much. Bye-bye. Thank you for watching this clip of our Options Tribe webinar. The rest of the recording is available on optionstribe.com. I'm Seth Freudberg and I've been hosting the Options Tribe since May of 2011. We've brought in options experts from all over the world to make excellent presentations to our members. So go right now to optionstribe.com to learn more about options education, or you can send me an email at sfreudberg@smbcap.com.